Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to our weekly podcast, The Week That Was, where we summarize financial market moves over the last week and what to watch ahead. It was another volatile week for asset markets, as we saw a dramatic escalation of geopolitical tensions with Russia's military action in Ukraine. On Thursday, Indian equity markets had its worst single-day fall since May 2020, with the Nifty index sliding by about 5%, entering into correction territory, which is a fall of 10% from the peak. The Nifty index is down nearly 13% from its October 2021 high. The cuts were sharper for the mid-cap and small-cap indices, with both indices entering bear market with a 20% drop from its recent highs. Markets did recover some of the losses on Friday, but for the week, the Nifty index was down 3.6%. All sectors ended in the red, with telecom, auto, capital goods, and energy seeing falls of 4% and above. Commodity prices surged, with Brent crude surging above $100 per barrel, while risk-off sentiment supported gold prices as safe haven demand rose. The prospect of higher commodity prices for longer, resulting in inflation staying for longer, pressurized bond yields, despite a risk-off sentiment. The benchmark 10-year IGB yield rose 11 bps to 6.77%. Short-term rates rose marginally, but corporate bond yields rose by 10 to 12 bps. The INR depreciated by 1% to close above 75. For investors, we believe it is important to separate the knee-jerk reaction from the bigger perspective. First, history shows that financial market reactions to major geopolitical events have usually been short-lived, with losses reversed over 3 to 6 months. Second, the Nifty index is already down about 13% from its prior peak. Looking at the past 10% plus pullbacks over the period 2005 to 2020, corrections have ranged between 10 to 15%, implying a significant portion of the current pullback may have already occurred, assuming there is no economic slowdown on the horizon. Lastly, the markets have priced in a significant way a lot of the policy normalization which is going to be undertaken by the US Fed and the RBI for 2022. So while it's always very difficult to time precise market bottoms, and given key technical levels have been breached which could result in greater uncertainty in the near term, the above perspectives argues that investors worried about the prospect of further volatility may be better served by adding risk hedges like gold rather than significantly reducing long-term equity allocation when we are already quite far into the pullback. So that's it. Have a great week ahead, and thank you for listening to our podcast. If you find it useful, please like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.